the pricing in the U.S. dollar. Now, we might have some of our own answers. Unfortunately, though, as individual traders, we can't answer very many of these questions. And so if we're going to be a trader and look at what the market gives us, we have to come up with some kind of a different approach that will work. And for many of us as traders, it's technical analysis, and specifically in the case here that we're going to talk about using the charts today from Vantage Point Intermarket Analysis software. Vantage Point is based upon intermarket analysis, and we know that when one market is affected, it also has ramifications for many other markets. So what Vantage Point does is find the 25 markets or so that are most closely or that have the most influence on the target market, and produce a set of intermarket data that can then be used in various indicators to come up with short-term market forecasts. I'm not a salesman for Vantage Point. I just happen to use the charts. I need to make it clear that if you want information from Vantage Point, we'll give you a number at the end of the presentation today that you can call and find out more information there. But one of the things about Vantage Point is, I say, the emphasis on intermarket analysis and the efforts that they have made with the computer, with the neural network studies that they have done, to come up with some of the best combinations of moving averages or the best other types of combinations to produce some various indicators that will provide short-term market forecast, which is the best that we can hope for in today's trading. Excuse me. Well, now we got a couple of crazy situations we want to point out first, and when we're talking about what's been going on in the market, we're going to talk about the situation that we have here with a market like silver. Now, we're not using this as a situation because, you know, look at silver here. Not much of a swing trading opportunity there, not much one there. You might be able to find a little, you know, back in here, and, you know, when we're talking about the swing trading type of thinking. But this market is one of those that's gone to extremes. You know, we've had that steep drop the other day. The steep drop that we had, I think, was something in the nature of $6.50, and we had this big candle here that dropped, and that's worth $32,000 for the full-size silver contract. I don't know about your account, but that's pretty rich for my account. And so at this point, you know, you would like to think that at some point silver is going to bottom, and you're going to be able to pick it up on the move up, but the risk at this point for most traders is going to be too great. So we're not looking at silver as one of our examples of a swing trading market. Just want to, you know, clarify that if you're looking for secrets to silver. Pretty much ditto with the gold market situation. You have the same type of situation, although if you look back here, you know, where that vertical line is, you see that's the start of May, end of April, and that's when silver was going crazy. Well, if you look at it in hindsight, when the market moved over here more recently, that kind of made that peak back then look pretty small, like small potatoes. You know, there are some things that, again, too risky. It's too much of a move, and so for an average trader looking for some short-term type of trading without taking on a great deal of risk, you're probably looking away from these markets. So what we're going to do, we're just going to flip these markets out of our system and not even consider them, and we are going to look at a market that represents a more, what we would call a more stylized silver or a swing trading type of strategy. Now, I talked about this in some previous webinars not too long ago, so I don't want to go over it too much if it's, you know, too repetitive. But you have a situation when we look at it where the market moves up, market swings down, up, and we have some kind of regularity there. Oops, I made that go too high because I should have been going this way, because that's where the market plunged. I think the previous webinar that we did, we were talking about prices somewhere in this time frame here on this candle here, and since then the market has simply you know, gone on to move down. But this is a good example of the type of swing trading type of mode that we would like to see. And one of the nice things about the swing trading situation is that sometimes when it does make that swing down, it turns into a trend, and you know, nobody's going to kick a trend in the teeth, because that's what ultimately we'd like to get. We'd like to get that bigger move if we possibly can. When we look at soybean futures, when we look at any market, when we talk about them, you have to consider some other things when you look at the market. One of the things about soybeans when we look at it is that they tend to be a little more volatile, you know, a little bit more bouncing back and forth with some bigger things. You have in the situation of soybean futures, the margin for trading one contract, last time I looked, there was $3,375. So I'm going to look at a little bit maybe smoother, more of a commercial approach that won't happen so much, and use that as my example for the swing trading, and that is going to be the soybean meal. This is a December soybean meal futures contract. The margin on that is $1,688. The shifts seem to be a little bit smoother. What you don't like to see in a move, if you're talking about being a swing trader, is those situations where you have the market going berserk in this little pattern right in here, where you have first one big candle down, one big candle up, one big candle down. You don't want to see a smooth move interrupted or interspersed with all those big long candles, because what happens if you set up a strategy gets you stopped out right away before you can even do a good job with your strategy to make it work for a trend. But we're going to look at December meal. We have here on the screen a 6-month contract for soybean meal. We're going to add a couple of indicators here that are provided by Vantage Point and try to analyze the markets a little bit to see what we're going to really come up with. And the first indicators that we're going to add, there are 3 of them here, and what we're going to add when we look at these is the predicted exponential moving average. It's a 4-day moving average that we're looking at here, and that's the blue line that you see there. And you have a 10-day simple moving average of the close. That's the black line. The moving average concept is fairly clear. When you have crossovers, it indicates a change in trend. The trend will be the angle of the moving average, pretty straightforward moving average analysis. And when you have the crossovers here to the downside and you have the moving average down, as long as that blue line, in this case the shorter moving average, the exponential moving average is below that longer moving average, the 10-day simple moving average, then you should be short. It's pretty much the same, simple as that. Now, there will be times in the moving averages where you'll have the choppy situations back and forth, and that's what we're going to try to look at a little bit today as to how to trade those types of situations. The other indicators that we have on this screen here from the Vantage Point software are the predicted differences. It's the blue line and the green line that you see going across here. These are the differences between a predicted moving average and an actual moving average. The blue line representing a medium-term moving average, and the green line long-term moving average. As I say, Vantage Point has determined what those 2 different moving averages should be. That's kind of what it has come out with, the best forecasting ability based upon their findings. The other indicator on the screen here is the predicted neural index. That's the gray line. That is a comparison of 2 3-day simple moving averages of typical prices. The typical price is the average of the high, the low, and the close. It's a little different than just looking at the close of the day. It gives you a little bit of a different feel, but it covers all the action during a given day, so you can see that what's going on, kind of the overall direction, the sense of the direction of the market. A couple of days that we need to highlight here, that are kind of noteworthy that we're talking about, is the June 30th, July 1st time frame there. That's when, in the case of soybeans, when the